Hi, this is Jim Cunningham. Welcome to Commercial Solar Hot Income Tax Strategy for High Earners. I have today with me two special guests that I will introduce here shortly. And just before we get started, this is a disclaimer. We're a law firm. This is not legal advice. There's no attorney-client relationship. The other professionals on here, there's no, this is a disclaimer. It's information only. So this is not any kind of form of legal advice. So subscribe to our YouTube page. If you're watching this live, you can go ahead and put a question in the Q&A. And if you're watching this on YouTube, go ahead and if you have any questions, you can put those in the comments, and we do monitor those quite a bit. So we have John McElwee here, also known as Johnny Mac. He's a financial professional for 3 years in solar energy and retail real estate space. He's handled over $12 billion in transactions. That's a huge number. It's a lot of zeros. And he's currently consulting and advising finance. He's in here 30 years experience as he is a former IRS revenuer, a revenue agent. He is the managing partner of Marcum, which is a national CPA firm. This firm's National Tax Controversy Group, and helps resolve tax controversies with the IRS, which is, can be really stressful if you're on the taxpayer side. And of course, Jim Cunningham, 25 years experience. We have offices throughout California. I'm a certified specialist in estate planning, trust, and probate law. I'm a real estate broker and securities and insurance licensed. So why are you here now? Most people want to pay the least taxes possible while securing a legacy for themselves, their family, and their loved ones. We're here integrated plan to reduce your overall tax bill, and this leads to more wealth for yourself, your family, and your loved ones. So, Phil, John, good friends of mine, commercial solar. Who's it for? What's it for? Tell me what's going on. What are some of the benefits? What are the, because we've done deals with clients. We've worked together in the past. Phil, if you can kind of outline who this is for, that this would be very helpful for the people watching this.
Yeah, who this is for is really a business owner. So if you have an S corporation or sole proprietorship or partnership LLC, this is for you. Also, the threshold begins at around $5 million of taxable income. So if you have $1 million of taxable income, you really don't have enough tax that you're going to want to benefit by investing in these. The other thing it doesn't work for is if you look at Jim's slide here, if you're just a W-2 wage earner, or you have a C corporation, you have wages from that, or you sell a C corporation, there's not a lot of benefit there. The benefit really comes from, as I said, the business owners in a flow-through entity, and even if you sell your company, have a liquidation event, this could be beneficial for that also.
Yeah, Phil, I'm really glad you mentioned that, because sometimes people think, wow, 10 million a year, like who makes 10 million a year? Well, first of all, there are plenty of people that do, but we also see a lot of people who work, frankly, they work their behinds off their whole life, right? And then it comes time to sell their company, and then they say, I got to pay how much in tax? Like, people get really mad. Do you know what I mean? It's like, I have worked this hard, and now Uncle Sam and whoever the governor is in California at the time, for us Californians, they're going to take what, half, a third? This is ridiculous.
It's a lot. It's a lot. So today we'll walk through some of these things, and that's why I'm glad that John is here with us, because John works with us and actually interfaces between us and our clients and the developers, because the developers tend to talk in terms of megawatts and projects and all of the utilities, whereas John distills that down into dollars and cents and tax credits. So that's why we're glad to have John kind of interfacing between us on the client side and the developers.
Now, before we get there, I'm going to go down a quick down and dirty on some terms that we're going to use. And we were talking before we got started, and what I find is it doesn't matter how much money you have, a lot or a little. A lot of times these are very confusing terms. They're hard to keep track of. If you're not, swimming in this language every day, every hour of every workday, it can be a little intimidating, quite frankly, and it can be a really confusing. So what we're going to cover, and we've covered these 5 points in a previous webinar I did with Phil, And that's on our YouTube page. And that was a few weeks ago. But what we're going to cover today are two really important, really what I would say key concepts in getting your head around this. Okay. Number one is a tax credit, and the other one is a tax deduction. So it's very important to understand the difference. A tax credit is the amount of money that is subtracted directly from your taxes owed. Okay. This reduces your deductions, on the other hand, reduce the amount of taxable income. Okay. So tax credits essentially pay the tax. It's like a coupon you use to pay your tax. And the credits vary whether you're an individual or a business. And there's a lot of detail, but on a very high level, let's look at Tom. Tom's income is $1 million. And here's what's going on is the government is encouraging you to deploy your capital in certain ways that benefit America. One of them is solar. This has been an initiative. This is not a Republican issue. It's not a Democrat issue. This is the United States government is backing the solarification, if you will, of the United States. So here, Tom's income is $1 million. He makes an investment that has a federal tax benefit of $100,000. Tom's federal income tax liability is $329. It is reduced by the amount of the credit, right? So his tax liability goes from $329 down to $229. It literally a tax credit essentially pays your tax. A tax deduction lowers the overall income, as we said. And so if Tom makes $1 million, he has a deduction of $100,000. His taxable income is now $900,000, and that reduces his tax bill by about $37,000. So 37 versus 100, I would take 100,000 less. You know, if all you could have would be a credit or a deduction for the same nominal amount, pretty much every rational human being would take the credit because it's almost 3x the tax benefit. And so the term tax benefit is really reducing it dollar for dollar. So again, saving 100,000 in taxes is better than saving 37,000 in taxes. And can you explain worst first, Phil? What does that mean?
Well, worst first means that the deduction goes against your highest marginal income. So for example, ordinary income has a higher federal tax than capital gain. So worst first means that your deduction goes against your highest taxed income before it goes against your lower taxed income, such as capital gain.
Good. So if you have $1 million in income and $1 million in capital gain, and you get $1 million deduction, you're taking that first off of your 37% tax rate versus your 20, right?
If you have ordinary income, right?
So another quick thing, cost basis, if you buy something for $1 and sell it for $3, your cost basis is $1. It's what you paid for it, right? And you got to pay tax on the profit of $2. It's very important when you are looking at return to look at after-tax return. And I will say this is one of the gaps between professions is financial professionals focus on return. How much money are you going to get? Is the CPAs and the lawyers are like, well, how much are you really going to get after you pay tax? And I think those two people need to come together. And I would say John is one of these people. So that's why we work with John. What is the best path for a client? And, if you purchase land for $100,000 and it goes up to 1.1 million, your basis is $100,000. Your gain is $1 million. Your tax is $371,000. Of course, if you have debt on that property, if you buy the property for $100,000, it goes up to $1.1 million. You take out $500,000, right? You borrow against that and put that in your pocket. Your profit's $129,000 because you gotta pay that tax on money you've already borrowed. So just very high level. So what we're going to do, we're going to turn it over to John. What we're going to do is look at, and by the way, this is public information. This is reported information. Kia Motors is a publicly traded company. This is all publicly available data that we're going over. But John, if you can walk us through why on the world would someone spend $10 million to build out a commercial solar array? Why would somebody invest that?
Sure. So thank you, Jim. I think the first part of the value chain we have to discuss is what's in it for Kia. And what's in it for Kia is they're not coming up with the $10 million off their balance sheet. However, they're going to get about a 20% reduction in their utility costs. And they also get, which is more than intrinsic value right now, of being able to say that their headquarters in Southern California is almost 100% fueled by renewable energy. So there's three different values there. Number one, their balance sheet, 10 million is still on their balance sheet. as opposed to investing in this project. Number two, they get a 20% reduction roughly in their annual energy cost. And in addition to that, the cost of energy in California has risen roughly 6.5% per year over the last 30 years, way outstripping inflation. But in the last 10, it's up about 12% per year. And we expect that trend, that steep trend, to continue. And the third thing is they can tell the world, if you put on CNBC on any morning, any annual report now focuses on ESG and carbon footprint.
And what's ESG? Yeah.
ESG is environmental, social, and governance. And carbon footprint, of course, how much carbon are you producing? And what is your plan to address all four things that are very, very important in this country, but also globally right now? So they get those three benefits. That's the first part of the chain. The second is the developer can come in and sell this entity to a third party, the third party being the tax investor, or somebody that's investing to own the asset and get the tax value. So that's kind of where we come in. We work with developers that offer the solution to off-takers, to somebody that's going to use the power. They're going to get a reduction in rates, intrinsic value, long-term off-balance benefit. The investor is then going to own the system. So this system, think of it as real estate, triple net lease with one tenant. The tenant is the sun. The sun produces power. It shows up every day. If it doesn't, we all have a far different problem. And then therefore, the investor can take that asset and use what we talked about earlier. Depreciation, tax credits, cash flow are going to be the three primary benefits to the investor, in addition to the feel good, we're doing something good for the environment, and the intrinsic value of being green or supporting green initiatives.
Well,
so I
John,
use this.
Yeah, John, let me ask you a quick question.
Sure.
If this is so great, why doesn't Kia Motors just put their own commercial? And by the way, commercial solar is like the big steel girders and the big panels where people park their cars under. This is not putting solar panels on your home or your office. This is a big project. Okay. Why wouldn't Kia do this? Why wouldn't they just write a check for 10 million? They're a publicly traded company. They can issue more stock. Why wouldn't they just do that?
Well, they could, but that 10 million is going to be a net deduction off their balance sheet. And then if you use the multiple of Wall Street, it's going to be worth 15 or 20x of the 10 million to them and their stock price. That's why they don't do it. It's not just the 10 million bucks. It's that 10 million extra on their balance sheet increases their net income by $10 million. And then they get a multiple on Wall Street in their stock value. So it's a financial mathematics or gymnastics between, if we outlay this cost, we can't put $10 million into another investment that's going to yield us 100, and this is going to detract potentially from our stock price. So that's the primary reason why these are great targets, because a developer can go in and say, hey, we'll absorb the cost. You get the benefit, lower energy cost, intrinsic value, nothing off your balance sheet, and we will pass this on to an investor. So that's primarily Kia could write the check. Phil, maybe you want to expand on that a little bit in terms of
what I'd also like to contrast before we really delve into the numbers and kind of walk through the example. This is a public company, but there's also a lot of nonprofits out there as well that do this. So it could be, pick a nonprofit. If it's a large nonprofit, Salvation Army, or some of the Catholic Church buildings, the diocese, etc. I mean, they don't have any tax appetite. They don't need tax deductions or credits. And so I think maybe, John, it would help if you talked about how the developers actually go about this and find these projects and then sell it. I mean, it's not a 6-month process. I mean, these are years in the making to find it, get the power purchase agreement with the, whoever the nonprofit is or the company, and then design, build, and implement before it's ready for the investor. I mean, it could be several years.
Yeah, that's a great point, Phil. So in addition, Jim, to the financial aspects, the development aspects, specifically in California, may be 2 to 4 years. And that is getting all the approvals to put a system on. Are you going to tie into the grid or be behind the meter, meaning off the grid? And if so, you have to have local approval, county approval, sometimes state approval, and then utility approval. So there's a long process, very similar to a real estate development, which Kia is not in the business of developing solar. And they could bring in a third party to manage and execute that, but it becomes their burden if they're going to invest in the system and own it outright. To Phil's point, this project, I think it was 3.5 years in development. It's live right now, but it took a long time and a lot of capital expense, legal, all the different petitions to the different entities to approve it, pre-construction, let alone the construction cost, et cetera. So yes,
Yeah,
it's an arduous process.
And why that's important is clients will come to us. We're in the month of October right now. They say, hey, great news. I'm selling my business for $10 million. How do I mitigate the tax bill? You can't go do this yourself because the taxes are due this year and these projects are 2, 3, 4 years. So you might be 4 years out. So you're not synced up on the time. And so that's why it makes sense to effectively purchase these that have been in the works baking, right, for 2 or 3 or 4 years. Paris has a question for you, John.
Sure.
And the question is, hi, John, are there further production tax credits that the investors get as the solar keeps producing year after year? Also, do the projects need to apply for safe harbor to get the production tax credit or investment tax credit?
Yeah, there's two very good questions and a little separate and distinct. There's 2 credits that are available to solar and a lot of different renewable energy projects. One would be ITC, the investment tax credit. The other would be PTC, a production tax credit. Most solar today focuses on the ITC, the investment tax credit, whereas oil or nat gas may focus on the production tax credit. The simple reason is it's a way to advance in year one effectively most of the benefit, where the PTC is going to oscillate based on production, which is much more volatile in the natural gas and oil industries. For this specifically, we have a 30-year horizon of what we expect a plant to produce based on 50 years of weather data. So this is pretty predictable science. And so the logic is most developers, most investors would prefer to have all that money, all that tax credit value upfront in year one. And it's a way to accelerate the return back to the investor. So that addresses the first part of the question. Go ahead, Phil.
No, are we finished answering the question?
Yeah.
I was going to interject. So, John, maybe give the
audience. Let me just address the safe harbor. So yes, this project specifically had panels. The tax credit rate was 30% up through 2019. However, there's a safe harbor provision that allowed you to take that 30% rate versus the current rate in 2021 is 26%. However, if you expended at least 5% of the project development cost in 19 or previous to 19, you can then deem the whole project at the 30% rate. So what this developer in this circumstance and most developers do, they will buy panels in the year of, they did it in 2018 and 19 in lieu of a rate decrease. So 2021 projects are benefiting from the purchase of panels in 2019. So yes, the panels and therefore this project in its entirety were safe harbored at 30% versus the current yearly rate of 26%.
Yeah, and what, John, what you're saying is earlier, you got a 30% tax credit. So if you spent 10 million on a project, you get a $3 million tax credit. Remember, that's the coupon that goes to pay toward your taxes. And that's
Correct.
been going down since 2019. But this kind of bootstraps it in a little bit, kind of allows you to use the older, better, higher tax credits.
That's correct.
So John, how does the developer find these projects? How did the developer find Kia Motors? Tell us that process.
Yeah. So, and again, this is I've been doing this for about 15 years, and there's self-origination, which is dialing for dollars, which is they have feet on the street that are knocking on the doors, calling Kia Motors, which is how this generated or originated, and they will start the process. That happened about 4 years ago. The other aspect is some projects, they'll be the reverse of that, where Kia or another company may say, hey, you know what? We got to get involved in this green movement. Let's call a couple developers and figure out what the process is. So it works both ways. And we work with companies. I'll have a lot of companies call me directly and say, hey, can you recommend a developer? I want to do solar on my roof or on my carport, or we have 28 extra acres adjacent to our corporate headquarters. And then I'll put in 2 or 3 developers to start a formal bidding process. So the origination side of this comes from the off-taker or the end user of the energy, and also from the developer. Again, Jim, maybe I should discuss this, that there's a term in this industry called the solar coaster, a pun on roller coaster. And just like anything else in life, I think it clearly follows Parham's principle. 80% of developers really are not good or new or not qualified or bad projects or a lot of bad moving parts. We focus on the upper tier, and I'm going to say the top 5% of the top 20%, and that's by design. Tree Tech Americas is one of our preferred partners. They started in Basel, Switzerland over 30 years ago. They have tremendous experience over 4 different continents. And so what I do is try to weed out the developers that maybe are not top tier and focus on the developers that are really good and are going to bring us great brand names like Kia, LA Water, and others that you can effectively de-risk a deal based on who the off-taker or user of the power is.
So John, if I want to invest in a project like this, I mean, do I need to go to Kia and have a meeting with Kia, or am I involved in? I mean, where is that at with their power purchase agreement? I mean, what are my responsibilities as an investor?
So the investor generally does not make direct communication with the off-taker. They will go through a developer. So this project, Phil, as you know, and Jim, as you know, we offered to a couple clients that had a substantial tax event, and they invested. Now they did their due diligence and they went to Kia, they saw the plant, they saw it in development and all that good stuff, but they did not have to create the structure or originate the deal. They just became participants as investors and owners of the project. So, and a potential investor does not have to find a Kia. They have to find a good developer or 2 or 10 that has projects like Kia that they then can buy and or own over the duration of the PPA. The PPA is an acronym for Power Purchase Agreement, which is Kia has agreed to buy 100% of the power produced by this power plant for the next 25 years. So it's a pretty solid structure.
Right. And so, right. So our clients, I mean, that's why they come to us, and that's why people go through us, or they go through Cunningham Legal. And then you're able to deal with all of the different developers across the country, find appropriate projects that work. And then what you're really doing in this case is, it's not a mere investment. And it can't be just a mere investment for it to qualify, Jim, because you need to actively participate. If you're taking a business loss, which the depreciation will generate, and we'll get to that in a few minutes, you actually have to take a business loss from a business. If you have active participation in your own business, S Corp, LLC, et cetera, then I need to actively participate in my solar business, which means I need to spend at least 100 hours per year. And there's a lot of different ways to do that. And that's something that we work with the investors and say, look, here are the different ways you can do that, and be involved with the developer, visit the sites, et cetera. So, that's important too. It's not just a mere investment and you walk away. Although if you have real estate income and other passive income, which we'll talk about, then you don't have a requirement to actively participate. So I just wanted to highlight that before you walk through some numbers, John.
Sure, that's correct. And just to put it in context, an active participant in the real estate business has to put 750 hours per year logged to be declared active in the real estate business. In solar, as Phil noted, it's just 100 hours per participant per project. And again, we structure around that to sell individual projects to individual investors. So they're the only ones that own it. They have financial risk or skin in the game, which is one of the IRS requirements. They don't manage it. We outsource that through Tree Tech and various third parties, but they have risk before the project is live, and therefore they can absorb 100% of the tax benefit. Jim, should I go through the numbers on a high level? Just
Yeah,
as this example?
Yeah, I think that's a good idea. Paris has another question. The tax credit
Sure.
that is applied, I believe, is only for the federal taxable income. How does the investment affect the state taxable income here in California? Is there a business limitation of 500,000? We're going to talk about that, but the short answer is, and Phil, you can chime in. The short answer is the feds allow you to essentially depreciate it in 1 year. California says you got to do it over 5. So you'll get it. It's just going to take.
That's correct. Right. And there's no California credit. Some states do have a credit. California does not. Some states follow bonus depreciation and allow you to take it all the depreciation in 1 year. California does not.
So let's just to tee this up so we can put some context around this. Let's say a client comes to us and they say, Jim, I'm selling my business for $10 million. I have enough money in savings. Yeah, I do need to live off this maybe a little bit, but really it just bothers me that I have to pay 35 or 50% or whatever the number is in tax, and that the government gets a third or a half or somewhere in between. That just really bothers me. And I will tell you, all three of us talk to clients and they say, it just bugs me. I'd rather do something else with the money. So let's say you have 10 million in income. And when I say income, not just income, but this, remember, it also includes the sale of a business. How do we cut the tax bill? John?
Well, first of all, let me just interject.
Yeah.
First of all, if you have 10 million of income, you're not going to do a $10 million project.
Right.
That's way too big.
Yeah.
So in this case, maybe you have $30 million of income. So John, go ahead and then you can walk through the numbers.
Yeah, thank you, Phil. That's a good point. And I just want to add to what Jim said earlier. I spent several years speaking at different events, real estate, renewable energy conferences, and working with people for the last 15 years. There's a extreme visceral and psychological difference with somebody that just realized they sold their business for 30 million. Oh, that's great news, but they've got to give up 14 in tax. When you save them tax dollars, it's worth more than making the money. And I don't know how to explain it other than there's the hamster with the pellet and the water, there's a reward of, I work my rear end off to create $30 million of enterprise value. Why the heck am I giving a third of it back to the federal and or state government? So when we can step in and show them how to mitigate some of that exposure, lower that exposure, it's distinctly different than the sale event or the earnings event that they had over time to create that wealth. So I just wanted to comment on that. I'm going to keep this very high level because I'm presuming we have a lot of people that are seeing a solar deal for the first time. And I'd be more than happy to go line by line and answer questions, but I'm just going to try to keep it short and simple. And then Jim and Phil can add or fire away. And if we have questions, that may be the best way to handle this. So I'll just roughly say this investment, and I rounded these numbers, but it was real close, was sold for roughly $10 million. So let's just use that's $10 million. The income side of that equation as it relates to the developer is usually a rebate. Rebates are being offered by most states right now for solar and/or renewable energy investments. Usually it ranges from 1% up to 5% of the face value of the project. In this case, it was 3.2.
And a rebate, what is a rebate?
It's a cash rebate back to the investor within 6 months of turning the system on.
It's a
So you
check.
it's a check. You get a check in your mailbox, in this case, $316,000. Okay. The ITC is short for investment tax credit. These panels were safe harbor. That's at a 30% rate or $3 million. The depreciation value, and this is a little quirky. I just want to go through this and then I'll focus on the cells in highlighted yellow. It's 85% rate. So you take half the tax credit, the 30%, half of that is 15. You deduct from 115, therefore you're left with year one, you can depreciate 85% or $8.5 million of the $10 million investment. That times a tax rate of 37% is how we come up with the 3.145 number. The depreciation, as Phil just alluded to, at the state level, I just modeled in 20% because you're taking 20% over 5 years. And then, of course, these projects are going to throw off cash flow. Cash flow is going to range from 2 to 6%, depending on the project, the utility rates, et cetera, on a state-by-state, project-by-project basis. So here's the short math. Let's just cut right to the chase here. You put $10 million up, you're getting $6.411 million in cash equivalent tax value, federal and state, year one. So what I like about this, and again, being in the investment business for 30 plus years, you've de-risked this deal. And again, I'm going to add the cash on top of that, 375. You've de-risked this deal a little more than $7 million in year one. So you put 10 million up, you get 7 million back in value almost immediately with the rebate, the cash from the actual production, and then all the 6.4 of tax benefit. So people say, how do you relate this to a 10-year bond, which has jumped up in the last couple of weeks to a whopping 1.6%? But you got to stay in the deal for 10 years. And if you sell it in year 8, you're going to take a significant haircut. In this case, you're getting roughly a 3.8% return on the top line. But to me, that's almost a misleading number. You're getting $7 million back. Cash equivalent tax value and/or cash plus rebate in year one. So 70% of your investment is coming back to you in the first year, unlevered. So now you have roughly 30% at risk. So now your 3.8% return, your $375,000 over the 2.898 is a 12.94% cash on cash return. And I challenge a lot of my colleagues in finance to find a better, safer return that you're getting the majority of your principal back in year one. What I like about this so much, and Jim alluded to this earlier, forget what side of the political aisle you're on, this movement is coming, and it's coming fast. In this country, 3% of electricity is produced by solar. It's going to be at 30%. The target that the government just moved up was 30% by 2030. That means a 10x increase in solar in the next 8.5 years. So if we get half of that, there's going to be a lot more solar and a lot of the value with that. But you have the federal and/or state government that pretty much giving you 70 cents on the dollar back beginning day one.
And you also, I'm looking at the state depreciation value of 266. This is for speaking for California. That's in the first year. You're not counting years 2, 3, 4, and 5, which is another million, assuming you have the income, it's another $1 million of tax benefit. So,
That's right, Jim. I have that on the, under the additional benefits section. And let's just put it this way, this $10 million investment over 25 years, unlevered, is going to get you 16.5 of value. That's not fantastic. That's not doubling or tripling your money if you look at it purely from the top line number and the end number. However, the way that I equate it is you have 3 million at risk after day one, and that 3 million is going to return you roughly 10 million years 2 through 25. So it changes the dynamic substantially. And you're going to have extra money in your pocket potentially to go out and invest in other things, whether it's your own business, Apple stock, or real estate, or whatever you choose. There's optionality here. So the way that we try to talk, Jim, to a lot of clients first is, look, you have an option. Send a check for, let's say, 12 million to the federal government, or invest 10 million and cut your check of 12 down to 4 or 5. And we'll turn that 4 or 5 into 9 or 10 over time. And so we go through that math of, if you send a check to the government, federal and state, you're never seeing that money again. Speaking of off balance sheet, it is off your balance sheet permanently. Okay. And it's gone. It's in the wind.
John, I've had people tell me, rather than give it to the federal government, because, and again, this is Republican and Democrat clients and all the other ones.
Yep.
They say, I'd rather just put it in the fireplace and set fire to it. I just don't want them to have it. You know what I mean? It's, and not everyone's like that, but this really hits, I think. And for those of you who are watching this, for those of you where it hits like your central nervous system and you're like, I just do not want to pay more tax. Like this, I lose my mind. Take a look at this.
Yeah, Jim, that's a very good point. We deal with a lot of investors that say, I know I can't get to 0, but get me to 20 or 25%. And Phil takes a very cautious approach with that. I'll let him chime in here, but they just want a significant reduction if possible. And here's the other thing. $10 million is in an envelope to the IRS, or it's on your balance sheet now. It stays on your balance sheet. And you may reduce your tax by 6.5. You own something that frankly is worth 20 million bucks over time. So as opposed to sending a check and letting the government spend it, you're investing a portion of that money and getting a very healthy return.
Charles has a question. How is the cash flow taxed in years 2 through 5?
Yeah, that's a great question. Why don't you answer that, Phil?
It's taxed as ordinary income because you're receiving income from your business, just like the business that you have now. So the only other deduction you would have against that would be the state depreciation. If you're in a state like California, where in years 2 through 5, you're going to have additional depreciation, which should absorb, if not all, then most of the cash flow.
Rocky asks, is there a depreciation recapture if we sell? What happens if we don't sell the entire 25 years? I'm assuming if you kind of hold it for 25 years, is there a recapture? Yeah.
Well, if you sell it, there would be depreciation recapture. If you sell it before year 6, you would have recapture of the solar tax credit, the investment tax credit, which is why there's an illustration, and we can speak about that. You could sell it after year 6, and yes, you will have depreciation recapture, but you will not have any recapture on the credit. So it's entirely up to the client and the investor, whatever they want to do. Some clients want to hold it for the long term and get the cash flow. Other ones may say, you know what, come year 6 or year 8 or year 12, we want to sell it for the present value of the remaining cash flows. There is a market for that because a lot of times family offices or insurance companies, there's a ready market because you've got predictable cash flow. So you can sell it, you could not sell it. Yes, it is taxable income when you receive it, or you just hold on and take the cash flow. The client that bought this likes the fact that there's cash flow every year and income, every year. It just shows up. You don't need to do anything to earn it. You've had your material participation. You've been actively participating in your first year. After that, if you want to do another solar project, you would need to actively participate, but otherwise the cash flow just shows up.
Paris asks for oil and gas and geothermal. The tax code allows you to offset active income if you join the investment through your personal name and as a general partner of the fund. For solar tax credit, as it can offset passive activity, do you need to also hold the investment in your personal name? So the question is, how do you hold title? Yeah, right.
Yeah, no, it doesn't matter how you hold title. Most of the clients that invest in this hold it either through a multi-member or a single-member limited liability company. I will say this, there's a distinction between oil and gas and solar. The rules for oil and gas are much more liberal, which is very interesting. Solar's not there yet. You have to actively participate in the solar to take a business loss. For oil and gas, you don't need to do that because in year one, you're treated as a general partner and then it flips. So the rules have not been extended to solar. I wouldn't be surprised if they were at some point, sometime soon, because with all of the emphasis on green and renewables, it just stands to reason that they would extend that out similar to what they have for oil and gas.
Now, John, what if if I say, this looks really good to me, but I'm net at risk 2.8 and change, and I'm getting 12%. But you know what? There's this really great investment. I can invest in a startup, or I can do, I need some more money out of this thing. I do have this asset. It is on my balance sheet.
Yep.
Can I extract some more value out of this asset that's on my balance sheet in the form of cash, quite frankly?
Yes, absolutely. So thank you, Jim. That's a great segue to the levered analysis. So again, I kept all the numbers high level and round by design because I figured there's a lot of people that are learning or hearing about this for the first time. So to Jim's point, beauty's in the eye of the beholder. Some people just want the unlevered return. Some people want the levered return. Some people that are aggressive want to see how much they can lever this up. Technically, you could go up to 80%, but then you might run into some debt service coverage ratio issues depending on the income that's produced. In this example, we generally recommend, and we find leverage for our investors anywhere between 40% and 60%. We tend not to go over 60 because you don't want to be upside down on the project. So just take that concept of what Jim said. You have a lot of savvy people on this phone, a lot of savvy advisors that have customers that are making money, making investments, and somebody's a tech wizard at finding the next big thing. And they're like, wow, I don't want to invest the 10 million, then I don't have 10 million to invest. Well, number one, you'd still have to pay that tax. So in this case, 6.4 would be going out the door for tax anyway, if you didn't make this investment. But also, what if we showed you a way to get cash back year one, so you have extra cash in your pocket? So you paid less to the government, state and federal, and now you have extra cash in your pocket. The way to do that, the only way to do that, frankly, is with leverage. So in this example, somebody gets 6.4 million of tax value, cash equivalent tax value, year one, plus another $600,000 between the cash flow year one and the SCHIP rebate in this example. Well, again, there's still $3 million in the hole. How did they get that $3 million back? We put 50% leverage on this project all day long, and our client is currently looking at this right now after the switch is turned on. So within 6 months, we can go out and get financing. It's a limited recourse loan, which means no personal guarantee. It's at the SPV, the special purpose vehicle level, which means the burden is on the solar plant. The burden on paying for the solar plant, frankly, is going back to Kia. So now a client pays 6.4 less in tax. They pick up $700,000 in cash, and then they get $5 million non-taxable event in their pocket, in their bank account. within 6 months. They can do that on their own, or we can arrange that for clients. Now, if you look at it, they put up 10 million. They have roughly 12 million of value within 6 months. So now they have an extra $2 million that they didn't previously have. Plus they reduced their out-of-pocket tax by the 6.4. So there's ways to structure this. And again, it's interesting. We work with a lot of financial advisors, and they're looking after their client's best interest, but they're in the job of managing money. So they want to manage more money, not less. So say, okay, is 12 million better than 10? Because 10's going out the door. And if I can get you 12 back within 6 months, you got an extra $2 million in 6 months that you didn't previously have any chance of managing because it was going to be at the Treasury. So once they get their arms around that, they could talk to their clients. And listen, we talk to a lot of business owners that are just flat out very good at what they do. They're cranking out money. It's amazing to me. Every day we find new pockets of good old-fashioned American success, businesses that are just exploding. And that person, that entrepreneur generally is he or she is pretty darn good at what they do. And they're going to be best at investing their own capital, maybe in their own business, maybe in other companies that are alike, or maybe they just happen to be really good at stock picking or something along those lines. So we want to give them the opportunity to, hey, sit tight for 6 months, and on 10 million, get an extra 2 in your pocket, and then you do whatever the heck you want with that. And if you can turn 2 into 10, God bless you, it's a beautiful country. So that's where leverage really comes in. If you have somebody that's a little bit more aggressive, and by the way, they can go tap their Merrill Lynch line for 1.5% right now if they have a balance sheet and a nice portfolio, or we can go to a bank or non-bank lender and provide that financing for the client.
Yeah, I mean, this is a great.
Jim.
Yeah, Phil.
Yeah, I just want to add on to a couple of things that John was saying. So when you're taking out the leverage, the reason why you can do this is because if it's in a partnership structure, that debt that you're taking on through that business, that debt creates basis. So it's not a taxable event. Now, if you go ahead and you sell it, shortly after that, you're going to have capital gain for the amount of your negative basis. So it gets into some complex tax issues. And so we do walk through that with the investors, but there is a way to do this. This works. You just need to look at the effects, because there could be a taxable event. Nothing is for free. There could be a taxable event down the line. So you want to be careful of that. And we walk people through all of those situations. So you have a lot of flexibility. You can do the project. If you want to take the cash and you want to borrow against it, you can. John put a 50% leverage amount on here. Generally, we see around 40% to 50%. So it just depends on the project, but that is, you have flexibility there. You don't have to do it. It will reduce the cash flow, because that debt service is taken over the life of the project, which in this case is 25 years. So it's going to reduce the cash flow because you've got the interest component where you're repaying the principal. The second thing I want to say is there's also flexibility on this as to when you exit. You can hold on to the project for the 25-year duration. And then I believe, John, on this project, on this specific one, there was a 5-year extension and another 5-year extension at the discretion of Kia. And so that's common also. The panels, I believe, are warranted for 35 years. And then the net cash flows that we're talking about, when you see, the cash flow is what, $375,000 roughly per year. And then it goes up a little bit every year. That's net income after expenses such as insurance, a management fee that the developer has, some maintenance costs, et cetera. And so that would all be in a more detailed illustration. Go ahead, Jim.
Yeah, I mean, this is just a great, for those that have this need, this is a great way to not have money go to the government in tax. It's actually a great way to get a return if you're not doing a levered deal, to get a 12, 13% return. And then if you're John, to your point, and I talk to business owners who are active in they haven't sold their business, but they're active in it. They say, that 5 million, I can make 15 million a year off the 5 or whatever it is.
Yep.
They're going to do way better. And they're 2 million ahead. So you put 10 into the machine and you get 12 back. I don't want to say it's a no brainer, but it's basically a no brainer, right?
For the right
investor. Yes.
And that's why people do it.
It's not for everyone,
Right.
but for the right person. And there is a barrier to entry also. You need to have a significant amount of income to take advantage of this. And it's relatively scalable based on this. I know this year there's not a lot of smaller projects, but usually there are projects starting at about the $1 million range. And they go up from there, anywhere from 1 million up to the largest one I think we've seen, John, is what, 45 million?
Yes. But we're working on, Phil, excuse me real quick, I call it my Legos model, where we have some much smaller projects that we can aggregate and potentially bring the threshold down. That will be 2022 business. But for right now, to Phil's point, our generic range is 1 million per project up to 50 and anything in between.
Anonymous asks,
and it's very,
sorry. So
I was just going to say, it's very difficult this late in the year because there is not a lot of inventory, but there were a lot of investors in Q1, Q2, et cetera. And there's much more inventory earlier in the year. So this is something to think about for next year, not just this year, but be thinking about for next year as well.
Anonymous asks, California real estate is out of control. Can this investment avoid tax on the sale of rental real estate? What about the sale of a principal residence, not a business?
No, not for a principal residence, but if you have real estate, whether it's multifamily residential or whether it's commercial, if it's a business, a trade or business, meaning you've rented the property out, you have income, if it's an income producing property, then yes, this can qualify against it. So the answer is yes, but not for your home.
Yeah, and it's interesting because what I see is this can be a meaningful alternative to a 1031. And something you need to understand, if your plan is to exit California and you own real property rental real property, and you 1031 that which is tax deferred exchange into property in Texas, you have to file a form every year with California. And then when that property is sold in Texas, right, you may have to pay California capital gains tax. This is an right. Alternative to that structure. Okay. Whether the numbers work or not is a different question. Rocky asks, are there any projects for sale for this year? What is the average closing time?
Yeah, let me answer that one, Phil. That's a great question. Yes, there are projects. We currently have an inventory of about $200 million worth of projects. Again, smallest one is probably just over $1 million. Biggest one is approaching 60. We expect to move at least half of that. What I found through experience, what happens is I'll field incoming calls from developers over the next 45 days. Just for the record, there's 85 days left till December 31st. And that's when you would have to buy a project and have at-risk capital to qualify for 2021 tax benefit. So we always say the window's closing, and each day it's 1 day off the clock. Mm-hmm. And we'll find in the next 45 days, I'll get 20 phone calls from developers saying, hey, I had an investor that bailed. I've got a project for $500,000, or I got a project for 50 million. Can you help me? So there's always the inventory. It depletes based on the time where we are right now, October 7th, but it'll fill up again, if you will. We'll sell 20 million and I'll get another 10 in the next 2 weeks that I don't even know of as we speak today. So we would not advise you to wait until December 1st. We would advise you to start thinking now. And to the second part of the question, the close process is pretty quick. Generally, again, in the beginning of the year, it might take 3 months to close a deal, just due diligence, reviewing the docs, a site visit, a couple calls with the developer, a couple calls with with Phil and the Marcum guys and or the CPA that may represent the buyer, or Jim or another advisor. Now we're closing deals in 2 weeks, 2 to 3 weeks. And a lot of it is, as we call it, we have for all you NFL fans, we have a draft board. And the draft board is on one spreadsheet, I've got all the investors and what they need to invest. On another spreadsheet, I've got all the projects. And it's kind of a jump ball situation right now. Well, this one's a first rounder and this person's ready to go with cash. They're going to get this project. And we always can backfill, but we don't want to be in a position where we cannot provide what we say we're going to provide. So if it's something that you're considering, I would strongly recommend you talk to your advisor, and we can all jump on a phone call and just analyze your situation and see if it warrants an investment. And if so, what size, what type of return are you looking for? What type of projects do we have that we can put in front of you to say, hey, this one fits what your need is. So we kind of bespoke everything based on what the investor needs and what their requirements are in terms of cash on hand and how much of their tax they're looking to mitigate.
Well, we have one more question, and I'm going to ask a question for Phil. Phil, if you can briefly, and if you guys have any other questions, go ahead and put them in there. We're going to wrap it up in a couple of minutes. Phil, if I'm a CPA, because I see on the attendees, there are a few CPAs that I know on this webinar, and they say, gee, I've got this client. Marcum's a CPA firm. If they say, gee, can I still continue representing my client, but also work with you? How does that work? How do you work with other CPAs?
Right.
If you could just briefly explain that.
So we don't have a CPA firm client relationship with the investor. Our client is actually John McElwee's company, and we get paid by the developer. So we are available to walk accountants, investors and their CPAs and their attorneys through the transaction, advise them on that. And if they do it, then we get paid by the investor. And if they don't do it, then then there's no fee.
Paid by the developer.
Fees paid by the developer, correct? Yeah, we're paid by the developer, and that's all wrapped into the cost of the project. Yeah. As far there was another question is what could go wrong with this investment, and I'd like to just address that, Jim. You have to have economic risk. So the project can't be completed in turnkey. You have to have some economic risk because you're really buying a business. So there's economic risk there, and the project has to get completed and signed off. Doesn't have to be operational, but signed off by the end of the year. And then there's also, there is risk. But it's mitigated by insurance. So when you walk through a more detailed example, you'll see that there's costs in there for the insurance and replacing the panels and all that sort of thing. So those are mitigated. And then there's always IRS risk. The IRS can always audit. Historically, they haven't audited many of these. Really what your risk would be with respect to the IRS, you're paying for it. Money is moving. It's going to be an operational project and it's going to produce power. So your risk is really, did you materially participate and are you active in the investment? So, and that's something we could address later with each one that has more detailed question.
Yeah. Well, if anyone has, go on.
Jim,
if anyone has any other questions, go ahead and put them in. We got about a minute and a half left.
Yeah, and I'll just add to that. Historically, this investment, this asset class, and it is a full-fledged asset class now, the default rate is about 10 basis points. So that means 99.9% of these deals go to fruition. I would challenge any industry, any sector to have as high of a default or as low of a default rate as solar right now. So these are very, very stable structures. Again, the risk mitigation, that's kind of my job. I only work with top flight developers, top flight off takers for the most part. And we take a lot of that risk, and then we buy developments or we invest in developments at or near completion to take away the execution risk.
Right. And if the let's say that Kia did go bankrupt and stop purchasing the power gets bought by the grid. So it's at a lesser dollar amount until that building is sold, and then whoever purchases the new building is under contract to, again, start purchasing that power.
Well, gentlemen, Phil, John, thank you for joining us here today. If you would like to
Thank you, Jim.
investigate this, you can certainly reach out to Cunningham Legal. You can also reach out directly to Marcum and Phil Wilson. And remember, subscribe to our YouTube page if you're watching this on YouTube. And we've got one more question in the Q&A. Oh, Charles says great seminar. Okay, great. Charles, thank you so much. Well, thank you for joining us today. And thank you again, Phil and John.
Thank you,
Thank
Jim.
you, Jim. Appreciate it. Have a great day.
You too.